I just want to talk briefly about one additional area of law that impacts all of these alignment strategies, and that's Revenue Proclamation 9713. This is an Internal Revenue Service revenue proclamation that relates to some Internal Revenue Code provisions that deal with restrictions or limitations on private use or private business activity being conducted on property that's been financed with tax-exempt bonds. Many hospitals use tax-exempt bond financing to finance capital improvements, and that comes with strings, namely, or including, there's a number of strings, but one of them being that you cannot use tax-exempt bond financed property in public to conduct public or private activity rather. And the cap is a 5% rule. I can't get too much into the details of how you measure that rule, but the consequence is we're always looking with respect to our use of bond finance property on whether we're complying with these Internal Revenue Code rules, and Rev Proc 9713 helps us do that. Under the applicable regulations, management contracts and incentive compensation agreements with physicians fall in that category of management contracts. These can result in private business use if they're not structured correctly. And Rev Proc 9713 tried to identify how do you properly structure your management contracts and your incentive compensation agreements with physicians so that you know you're not triggering private business activity. The general rule is that your management contract can constitute private business activity if you structure your compensation in a way that is tied to a share of net profits. And so what ends up happening under Rev Proc 9713 is a kind of complicated matrix on how you structure your compensation packages so that you aren't triggering compensation or tying compensation to a share of net profits. I can't get into the matrix itself tonight. Anyone who knows Rev Proc 9713 would be happy about that. But I can tell you that the guidelines or safe harbors that Rev Proc 9713 set out are too limited to allow you to compensate for the quality measures you're trying to compensate for under a lot of these structures and the productivity measures you're trying to compensate for. Bond counsel are increasingly growing concerned with some of the creative compensation methods that we're seeing. And we've run into more and more occasions where bond counsel look at these management contracts and say, I am not comfortable issuing a bond opinion that says your property does not have private use and therefore these bonds will be tax exempt because you aren't falling very neatly and very strictly into the safe harbor set out in Rev Proc 9713 and its progeny. And so what we want your takeaway to be for this is please, please pay attention to Rev Proc 9713 when you're structuring your compensation models, because whether or not you have tax-exempt bonds financing any of your property today, if you are in, have a transaction on the horizon that maybe involves a merger or affiliation, bond counsel may get involved and they may run into a barrier with issuing their opinion, and it creates a real problem in transactions. We've run into that a number of times. I do last want to say that NABL, National Association of Bond Lawyers, American Hospital Association, and others have issued recommendations to the IRS asking them to modify Rev Proc 9713 to loosen up these safe harbors or broaden them so that you have more flexibility with incentive compensation, but more to come on that.